Global financial markets are responding to the escalating conflict in the Gulf, but the reaction so far has been uneven rather than catastrophic. Oil markets have seen the sharpest move. Brent Crude has surged close to $115 per barrel, rising sharply in just a few days. Gold prices tumbled as investors moved towards the US dollar and other defensive assets. Equity markets initially sold off as the conflict escalated. South Korean index witnessed record fall, though it paired losses the very next day. The sell-off has been relatively contained so far, suggesting investors are still assessing whether this will become a prolonged economic shock. Despite the geopolitical escalation, global markets are showing surprising resilience. One reason is that investors are still betting the conflict will remain geographically contained and relatively short-lived. Historically, markets tend to stabilize after geopolitical shocks unless global trade or energy supplies face sustained disruption. Second, financial markets are still supported by strong positioning in major sectors such as technology and energy, even as investors rotate away from riskier assets and smaller companies. Markets therefore remain volatile, but they have not yet priced in a full-scale global economic crisis. The real risk for global markets now lies in energy supply. The Strait of Hormuz normally carries around 20% of global oil and gas shipments, making it one of the most critical energy choke points in the world. Oil prices have already breached the critical $100 a barrel mark, triggering renewed inflation pressures across major economies. That could delay interest rate cuts, weaken global growth, and trigger deeper corrections in financial markets. Market moves this week will determine how this war unfolds.